Hello everybody and welcome to our discussion on the proper allocation of Medicare charges from the PSR. There are two subtopics we're going to talk about in this video, and these relate to routine versus ancillary classifications and the improper use of the percent to total PSR allocation method. So to start our discussion, we're going to talk about an overview of cost finding, which covers the worksheet A through D series on the cost report, and we'll talk about what cost finding is in just a bit. And then we're going to get to the heart of the issue, which is the allocation of Medicare charges from the PSR to the cost report. And that brings us to the two specific topics of the improper allocation between routine and ancillary, and the improper use of the percent to total Medicare charge allocation method. So first of all, let's talk about cost finding in general. The idea, one of the main purposes of the Medicare Cost Report, is to identify out of all the total costs that a Medicare provider has, how much of them relate to providing services to Medicare patients. Now, there are a few different ways this is done, and we're going to talk about this by starting off with Worksheet A. This is the identification of the proper direct costs for each type of cost center. Now, for this to make any sense, we have to understand a couple of different terms here. On the provider side, when a provider is maintaining their financial accounting systems and their general ledger, the terminology is accounts. That's the term used to classify and categorize all the different types of transactions. So we have the accounts on the provider's financial accounting system. The Medicare Cost Report, on the other hand, there is no account name. That's not the classification. It's cost center. So what we're going to see throughout a lot of this video is that we have to identify where do all the various accounts from the financial accounting system, what cost centers do they go to? Now, the term for Worksheet A is grouping, and you might take multiple accounts. Generally speaking, the accounting system of a provider will be much more sophisticated than the level of complexity in the cost report. In other words, multiple accounts on the provider's system need to be grouped into various cost centers. So that's what we're going to see later on. Now I have Worksheet A6 and Worksheet A8 listed because there are some reclassifications that need to be done to move costs. Even though they might have been grouped to a particular cost center on the cost report, the Medicare rules of accounting might require you to move them to a different cost center, or possibly move them to a non-reimbursable cost center. Worksheet A8, this is either a positive or a negative adjustment to completely revise that number. Not just move it around, but revise the total amount altogether. So again, it boils down to how those are grouped. That's the classification terminology we use for that. Now, Worksheet B and B-1, what we're doing here is we're taking a look at which of those costs in Worksheet A were directly assigned to an overhead cost center, a general service cost center. The term direct here just means that they very clearly relate to that classification of cost. But the problem is, on the Medicare Cost Report, the goal at the end is to identify how much of the cost relates to various revenue-producing cost centers. So anything that's up in the general service overhead cost centers needs to be stepped down to the routine, ancillary, outpatient service, and special purpose cost centers that are revenue-producing. And we'll see why that revenue-producing portion matters. And actually it matters because of Worksheet C. So by the end of Worksheet B or B-1, all of the costs have been classified into the proper revenue producing cost center, routine or ancillary or these other ones. Now Worksheet C, and by the way, with Worksheet B and B-1, we're still on total costs. We still have no clue how much of those costs related just to Medicare patients. Worksheet C, now we're identifying total charges for each type of cost center. And again, of course, these are only revenue producing cost centers. And that is the reason we needed the costs in the revenue producing cost centers as well, because what we're going to do on worksheet C for all the cost centers except for the routine, and we'll see why in a bit, we're going to identify a cost to charge ratio, which is just basically us identifying what percentage of, so it's total cost divided by total charges, to identify what percentage of every charge dollar really relates to underlying cost. And we'll see an example later on. That's generally a reduction factor, and that means there was markup built into the charge, which is again common, but there could be some situations where it's over 100% for a variety of reasons, and that's fine. So the point is, by the end of worksheet C, we have a cost to charge ratio for each and every cost center. Now the worksheet D series is what we're going to actually spend most of our time on throughout this video. It talks about apportioning the total costs into the Medicare cost component. That's the goal of all the different worksheet D series worksheets. Now for this to make any sense and to explain some of the other issues we have to define a couple things here. First, we have to define routine. Routine costs, routine charges, routine services, whatever. We're talking routine here. By the way, this is sometimes referred to as accommodation. And in fact, when we see the PSR later on, the term accommodation is used for some reason. I don't know why they didn't stick to the same one, but they are the same thing. Sometimes it's informally referred to as room and board. Now, the idea here is that any charge related to this particular type of service is bundled into a room and board per diem. So we're not trying to track which of the patients actually used that particular service. The fact that they were in a room and that service is kind of built into the room makes it a routine service. Now, I do want to stress here that one of the things that determines this, if you take a look at the PRM 15-1, section 2203, we're looking to determine whether there was a separate charge commonly made for use of that service. That's what determines its routine. If there's no separate charge commonly made, then it's routine. But this policy manual takes that a step further and says it's actually common or established practice of providers in the same state. So it's not even so much whether that particular provider separately charges for those services, it's whether it's a common or established practice. Now, we're not going to dig into too much detail because we have a different YouTube video later on that will go through that in more detail, but I just wanted to point that out. So what happens here is these routine services, since there's no reason to believe that one patient in that same general acute care bed or that room might use more or less of a particular type of routine service, we can't apportion them based on charges. We just simply apportion them based on days. If you're in the room for 1 day, you get whatever that per diem was. If you're in there for 2 days, you get 2 times that. So those costs are not apportioned based on charge, they're apportioned based on Medicare day. Now, just to give you a simple explanation of how that works, and by the way, this is heavily oversimplified, there are some adjustments that come into play, but you take the total cost for that particular type of routine cost center. It might be your adults and peds, it might be an intensive care unit, it might be a coronary care unit. They all have their own cost center, but you take the costs for that cost center, total costs, divide them by the total days to get a cost per diem, a cost per day. And that's multiplied by the Medicare days for that same cost center, same department, and you now have an approximation of the Medicare cost related to those patients. Now, I want to stress here that routine charges are not actually used for routine cost apportionment, but that doesn't mean we don't pay any attention whatsoever to routine charges. They do still get reported on the cost report because they do get factored into the outlier cost to charge ratio and they impact the outlier payments. So the charges are reported there on worksheet D-3, as we'll see later on, but it's just the charge. There's not been a cost to charge ratio established, and there's no cost apportioned on that worksheet. It's just charges, and the outlier calculation is a separate discussion altogether. Now let's switch over to ancillary. They're essentially the opposite of routine. With ancillary, there is a separate charge commonly established for that service, and only patients that actually used that specific service are charged that amount. So these are things that are usually easier to identify. X-rays, labs, drugs charged to patients, things like that. Not every patient that's in a hospital room for a day gets all those same types of services. Patient A may barely have anything above normal room and board. Patient B may have substantial ancillary charges. So it's very unique to each patient. That's why it matters. Now these are apportioned via Medicare charge, and this is actually what our main focus today is. We're going to see this apportionment, how it's done, and by the way, the cost to charge ratio is used to effectuate this apportionment. The cost to charge ratio is taking your total costs for that cost center divided by the total charges for that cost center. You get a cost to charge ratio that we'll see later on, and that's multiplied by a Medicare charge for that cost center, and that tells you how much of those total costs were Medicare costs. Now, these Medicare charges impact the outlier payment as well, but again, that's outside of the scope of this discussion. The key point here is that classification is critical, mainly between the routine and ancillary, but also just the proper cost center in general. There are multiple routine cost centers, multiple ancillary cost centers. Classification into each of them is proper. But furthermore, we're not just talking about Medicare charges on the PSNR. We need to know how the costs were classified, and we need to make sure the B-1 statistics are classified in the same manner, total and Medicare days, and total and Medicare charges. They all need to be reported. If they're the same type of service, basically the cost and the statistic related to it, total and Medicare day related to it, total and Medicare charge related to it, they need to be reported in the same cost center. But the trick to that, it's sometimes misunderstood that you start with your costs, and however they were classified, everything else has to follow suit. That's actually not necessarily the case. There are more restrictions with how the PSNR charges are allocated because they're billed a certain way, they go through certain edits, they show up in a certain place on the Medicare cost or Medicare PSNR. That is in many cases what drives the classification. So that tells us whether it's routine or ancillary, and then any of the costs or statistics or total items that are related to those same types of things from the PSNR need to be grouped into the same cost center that the PSNR charge went to. So if the PSNR charge went to a routine cost center, any costs or statistics or anything else like that relate to that type of service need to go to that same cost center. Now, the grouping is largely determined by the provider. There are certain rules that come into play. How they set their accounting system up, that's completely up to them. They might have a very sophisticated accounting system with things broken out into great detail, a lot of granularity, or there might not be as much of a breakout. But the point is they had to group all those accounts into various cost centers on the cost report. They're having to do it for their costs or expenses. They're having to do it for their charges, both total and Medicare. That's the key thing here. But the PSNR charge, however that was classified on the PSNR, routine versus ancillary, that's what determines how everything else must be reported as well. We'll get back to that in a little bit again. But here's a PSNR example just showing that. Again, you have the charge section. First you have your statistics, your Medicare days, that's important. But then you have the charge section, which is really what we're talking about today. Again, they use the term accommodation. That's just your room and board. That's your routine. It's the same thing, just different terms. And notice they had a couple different revenue codes related to those types of charges. There are many more than these two, but this particular provider only had these two at this point. Then you get down to the ancillary, and they had multiple other types of services, revenue codes. So they had pharmacy, some IV solutions, lab, various lab ones, and they have the total or the Medicare charges related to each of those revenue codes. A couple things I want to point out here. First of all, the revenue code is a 4-digit code, although many of them start with 0 until you get later on. That's perfectly fine. But these revenue codes, this is the breakout that the billing system requires. It's not going to be the exact same thing as the provider's accounting system for their costs or even their revenues. They're going to have their own account numbers. And furthermore, the Medicare Cost Report has cost centers, which are going to be different altogether. Later on, we'll see that the critical piece with this PSR is identifying which of these revenue codes goes to which cost center. We need to be able to allocate them, crosswalk them, group them, whatever term you want to use. Here is D-3, just as an example, worksheet D-3 of the Medicare Cost Report. Over on the far left, you'll see the cost center numbers, the line numbers. These are the cost centers. Now notice there are 2 digits, well, sometimes 3 when you get toward the end, but it's usually 2 digits with 2 decimal places after. You might have subscripts. This code right here, it's a 5-digit code. This is actually a cost center code, which is just, it's a separate thing altogether. It's a way CMS classifies the different types of cost centers, but this is not what we're talking about here. We're talking about the cost center line number. Now, these are broken out. Notice we have inpatient routine. Then you have some ancillary cost centers. You get down here and you have some outpatient cost centers. Column 2 is where the Medicare or the program charges are going to be reported. These come from the PSR. But we need to take all those revenue codes from the PSR and figure out which of these cost centers do they belong in. Those Medicare charges are then multiplied by the Medicare or by the cost to charge ratio that came from worksheet C to determine the allowable Medicare costs. That's apportionment. We're taking total costs from worksheet C and apportioning them out to Medicare costs on worksheet D-3 and D Part 5. Those are your main two. So the cost to charge ratio is how that's done. But if you don't group things properly, if they're not crosswalked properly, this column 3 could be drastically different. Just take a look at the cost to charge ratios here. Here we had cost center 54, radiology diagnostic, and it had a cost to charge ratio of 11.5, just rounded. So that means that out of every Medicare charged dollar, 11.5 cents of it is going to be allowable Medicare cost. So they had $72,102 from the Medicare PSR that amounted to $83.19 of allowable Medicare costs. Now, if this was a critical access hospital, this directly impacts their cost reimbursement. For acute, it might have a pass-through impact or might just be informational only. But let's just say they accidentally, or maybe it was just a complete typo or whatever, they allocated those charges into cost center 56 instead, radioisotope, completely different thing. That has a cost to charge ratio of 76.32%, which means that every dollar of Medicare charge gets 76 cents instead of 11 cents. You can imagine that number is going to be considerably higher. So the grouping does matter. Now, whether it's higher or lower is irrelevant. Whether it's wrong is what matters. So we've talked about the grouping, and providers determine the accounting system that's used internally, how sophisticated it is. They have to identify how they've grouped the various cost centers into routine and ancillary and each specific cost center. Now, a couple of additional terms here. So you have the provider's general ledger, their internal financial accounting system, the cost or expense accounts. Those are grouped to cost centers on worksheet A series. Total charges from the internal revenue accounts are grouped to cost centers on the worksheet C series. And then the Medicare charges from the PSR revenue codes, they have to be grouped to cost centers on worksheet D-3 or D Part 5. Now, as we said earlier, your PSR charges, they already have been billed a certain way, they've already been processed a certain way, and they show up on the PSR as either routine or ancillary. We need to identify, well, the provider needs to submit the crosswalk for how they've allocated those revenue codes to cost centers. Again, it's often referred to as a crosswalk. It's just an allocation schedule, whatever term you want to use. But the key thing is they have to be within the same routine or ancillary classification. We just need to know which specific cost center they go to. In other words, which specific cost center do they go to? And then the costs and total charges need to be reported the same way. So, as we've said a few times now, these routine revenue codes cannot be allocated ancillary or vice versa. CMS has had quality findings when they've done quality reviews. MACs have received findings for allowing that, and it's been made very clear that this is not to be allowed. So routine versus ancillary allocation or cross allocation is not allowed. So now let's talk about the Medicare charges on the PSR. We saw an example of that. We'll actually see the same screenshots in just a little bit. But the issue here is that the PSR that's used at the initial submission of the cost report might actually change by the time the auditor looks at it for final settlement. There might have been some new claims that weren't processed before. There might be revisions to existing claims, whatever the case may be. The point is the auditor has to use the current PSR in effect at that time. So there might be revisions to all of the Medicare charges, the total Medicare charges. And we need to see what crosswalk or allocation schedule was used for those various cost centers. That's really what it boils down to. And we need to apply it at the time of final settlement. Now let's take a look here at the allocation methods that are available. Now, from a provider perspective, you're taking a look at when you're filling out this worksheet S-2 Part 2. This is not the normal S-2 worksheet that has your core questions that drive a lot of the cost report. This is worksheet S-2 Part 2, which is the informational hospital questionnaire. If you've worked with Medicare for a while, you may recall it being CMS 339. It was the Form 339 back in the day. But there are two basic methods that are commonly used. Method 1, if you look at line 16, was the cost report prepared using the PSR report only. In other words, all the charges that are in each revenue code on the PSR, that's the only information we have. And then there's a standard crosswalk built into the cost reporting system that identifies where those particular revenue codes generally go to. Which cost centers do they generally go to? Some of them are pretty obvious. Now, there might be cases where there are some that are missing. So you might have some charges from the PSR that don't get allocated to a cost center because there's not a standard allocation. In those situations, we would need to work with you as a provider to find out where they're supposed to go. What cost center do they relate to? Some of them are obvious, but some of them we would need more assistance on. Now, line 17 is method 2. It's referred to as method 2. It's where the PSR is used for total Medicare charges. In other words, the sum of all the Medicare charges. And then the provider's records are used for allocation. These are sometimes called, the crosswalk or sometimes a statistical allocation. But we need to identify what you used at the time of submission of the cost report, initial submission of the cost report, and we're going to reapply that with the new PSR. Now, there's an underlying requirement that the crosswalk must be logical in terms of allocation. So if we take a look at a revenue code and it's been allocated to a cost center that has nothing whatsoever to do with that type of service, that might be called out. But there's a fair amount of leeway given there for how you allocate things, as long as it makes sense. What cost center it's going to makes sense. Again, there's no routine to ancillary cross allocation allowed. Routine has to go to routine, and ancillary has to go to ancillary. However, you can, and many providers often do, have one revenue code from the PSNR that's split between multiple cost centers, just based on how it's used. 25% of the revenue code might normally go to this other cost center, or you might have, instead of just a straight percentage, you might have an actual statistic that shows that. And that's perfectly fine. You can have that one-to-many relationship, and quite commonly you're going to have a many-to-one. Many revenue codes go to one cost center. That's perfectly fine. The point is we need to see what that crosswalk is, what that allocation schedule is. The critical piece to bring up here is that what's referred to as percent to total allocation is not allowed. This is another thing CMS has made very, very clear through recent cost findings, that they have never intended this to be allowed, and we are not allowed to accept it. So first of all, let's define it. Some providers may be familiar with what this is just by the name. Others may not fully understand what we're talking about here. But the idea is that when percent to total allocation is used, we're trying to base the adjusted PSNR allocation that, again, might have brand new claims or adjusted claims, and that's being based on whatever percentage of the original total Medicare charges went to each cost center. The problem with that, at first glance, it seems to make sense. It seems to be a nice, easy shortcut to get the final result. The problem is there's an erroneous assumption inherent to this that any changes that have occurred in the PSNR since the original submission occurred evenly across all revenue codes. And that's just flat out not often the case. The claims that are adjusted might fall into just a couple of the revenue codes, where most of the revenue codes may not have had a change, or may have had a minor change. The point is, this assumption, it's a faulty assumption. They might all change, but the likelihood of them all changing in the exact same proportion is extremely low. So again, just another screenshot of our PSNR. We have all these different revenue codes, and we have all these charges. Now, providers, you would have used one PSNR, the most recent one available when you submitted the cost report, and now auditors need to fill out or need to run a new PSNR based on when they're doing the cost report final settlement. And things can certainly change, up or down. And here's the worksheet D-3. Again, the whole point of the PSNR allocation is to try to figure out how much of those Medicare charges go to each of these different cost centers on D-3 or D Part 5. So we need to see what crosswalk was used to map these revenue codes to these various cost centers. Now, to really drive this point home and to show why CMS dislikes this method so much, we're going to show an example of potential errors that could happen when using the percent to total allocation method. Now, I want to make a couple points here before we get into this detail. We've already looked at what real revenue codes are, or what they look like, what real cost center codes look like. And just by glancing at the name of some of these, it might be very clear which cost centers they might relate to. Now, here you had a few different labs, a few different laboratory revenue codes, but you know what? You have a laboratory cost center here. Maybe all those labs were grouped into the same lab cost center, or maybe some of them were and some of them went elsewhere. There are a lot of things that can happen that would cause them to have to go somewhere else, to a different cost center. But the point is, we need to know what that crosswalk looked like. Now, those were real revenue codes and real cost centers. To drive this point home, because the math, there's a lot to talk about here, why this matters. So to make it as very clear, to simplify it as much as we can, I tried to use generic revenue codes. In other words, nothing real from the PSNR and generic cost centers, just to drive this point home. Now, what you see down here, by the way, we're also going to show an extreme example, which is very unlikely to happen in reality, dollar-wise, that much of a change. But when you see that drastic change, it really shows you why this is such a faulty method to begin with. Now, even if it's a smaller change, it's still a faulty method, but having it extreme just makes it very clear. You can call it out right away. So those are the two things. Now, what we see right here, again, a provider can submit their crosswalk in any manner. This is just a screenshot of a few things just to define this. But here we see for revenue code 1 from the PSNR, the provider decided that 25% of that should go to cost center 1, 60% to cost center 2, and 15% to cost center 3. And they probably have some statistics to back this. Whatever they've done, this is the reason, or this is what the result is. Revenue code 2, 15% went to cost center 1, 85% went to cost center 4. And then revenue code 3, it was a 25-75 split. Revenue code 3 only impacts cost centers 3 and 5. Now, if you take a look at the original PSNR charges that the provider would have used at the time of acceptability, the revenue code 3 number, the charge number, is very small. It's only 4.42% of this total $9 million in charges. Most of it's in revenue code 2. 83% is in revenue code 2, impacting cost centers 1 and 4. But this really small amount only impacts cost centers 3 and 5. So the percent to total is only 4.42% there for this revenue code. Now, column 5 here shows what the revised PSNR charges are at final settlement. If you notice the first two revenue codes, they barely changed by $5,000 and $100 respectively, compared to $1 million. That's a very minor change. But revenue code 3, for whatever reason, and again, this is unlikely to happen in reality, but it went from $400,000 to $19.8 million. So that had a $19.4 million increase, and the total Medicare charges went from $9 million to $28.4 million. So that's what's going to drive this discussion. Notice that this change, this $19.4 million of extra charges, logically should have only impacted cost centers 3 and 5, because those are the only cost centers that get their charges from revenue code 3. That's the point to keep in mind as we continue on. Whoops. Go back here. The problem is, when you take a look at, if you apply these charges against these statistics, so you follow these rules to identify which cost centers they go into, here's what you arrive at using the original PSNR charges. Again, that was $9 million in charges, and here are the cost centers that they would have gone to. Remember, keep in mind, 3 and 5 were the cost centers that were impacted by that major revenue code that changed. But at the beginning, they were pretty small because there's not a whole lot of charge in the initial PSNR. So they only had 3%, just barely over 3% of the total Medicare charges went to those two cost centers under the original allocation. Now, if we just apply the percent to total, what that basically says is if cost center 1 had 15% of the original Medicare charges, it should have 15% of the new Medicare charges. And if you take a look at cost center code 4, or cost center 4 specifically, that one had 70% of the original charges. So using percent to total, we would say it should have 70% of the revised charges as well, which makes no sense because cost center 4 was not impacted by that revenue code revision. Remember, that revenue code 3 only impacted cost center 3 and 5. Right away, you see a major flaw in the system. If you instead just take your new charges and apply those same statistics that you had before, apply the crosswalk again, here's what you arrive at. Cost centers 1 and 2 didn't change much from the original allocation. $1,000 and about $3,000 of change, not much. Cost Center 4 only changed by $85 if you use that original statistic. But notice Cost Centers 3 and 5. They went from 272,500 of allocated charges to 5 million. And then 5 went from 300,000 to 14.8 million. And that actually makes sense because, again, more of the new charges related to cost or Revenue Code 3 that impacted Cost Center 3 and 5. So, of course, most of that change should impact those two cost centers. So that's the point to make, that reapplying the statistics, reapplying the crosswalk is the proper way to go. Trying to rely on some percent to total is not, because any major change that happened to just a couple cost centers would not show up properly. And if you take a look, if you reapply to get a new percentage of total charges using this green method, where we just reapplied the statistics, you'll notice now that Cost Center 5, it originally only had 3.3% of the original allocated charges. Now it has 52%. Because, again, most of those charges impacted Cost Center 3, or Revenue Code 3, and Revenue Code 3, 75% of that went to Cost Center 5. So that makes perfect sense that you'd see such a drastic increase there. Now, again, just as a wrap-up, CMS has made this clear in multiple quality review findings that they are not going to allow this method. And if we continue to allow it, we will, as a MAC, see cost findings. And we cannot have that. They've made it clear that providers are not to use that method. And I want to stress here, regardless of what might have been done in the past, whether a MAC has allowed you to use that method or not, whether they've given explicit permission or whether it's just been implicitly allowed, passively allowed, it's no longer going to be allowed. Instead, we have to identify what that proper crosswalk is, what your statistical allocation is, and reapply it. Now, the other thing about this has to be an immediate adjustment. We cannot delay this and do some management recommendation only treatment for a year or 2 or 3. It has to be applied immediately. The provider would have had a crosswalk at the time they filed the cost report. We need to see what that crosswalk is and be able to reapply that. The other thing I just wanted to reiterate, I mentioned it a bit ago, but, if there is something very illogical in that crosswalk, it's trying to allocate a certain revenue code to a completely unrelated cost center, then that might be subject for review as well. So just wanted to stress that point. Hopefully this has helped to clarify this issue, whether you're on the provider side, whether you're on the auditor side, or anywhere in between. Hopefully this helps to clarify why these are not allowed at this point. So I thank you for your time today, and I will look forward to talking to you in our next session. Have a good one.